Risk management techniques. Value at risk, VAR. Calculation and interpretation of VAR. Value at risk, VAR, is a key risk metric that estimates the potential loss a portfolio might experience over a specific time at a given confidence level, helping institutions manage risk exposure. Components of VAR. Confidence level indicates the probability threshold, often set at 95% or 99% for measuring potential losses. Time horizon. The period for calculating VAR, example, daily or monthly, tailored to the portfolio's risk management needs. Loss amount represents the maximum anticipated loss within the chosen time frame at the specified confidence level, guiding risk management decisions. In summary, VAR assesses risk exposure by indicating a loss threshold, helping investors make informed capital allocation decisions. Methods for calculating VAR. Value at risk, VAR, calculation methods differ based on portfolio structure, data, and precision requirements. Historical simulation. Approach uses past returns data to simulate potential losses, assuming that historical patterns could reoccur. Calculation. Sort past portfolio returns and identify the loss threshold at a chosen confidence level. Example, the 5th percentile for a 95% level. Pros and cons. It doesn't assume a normal distribution, but relies heavily on historical patterns which may not repeat. Variance, covariance, parametric method. Approach assumes a normal distribution of returns and uses the portfolio's mean and standard deviation to estimate risk. Calculation. By calculating the portfolio's standard deviation and mean return, VAR is derived under the normality assumption. Where M is the mean return, Sir sigma S is the standard deviation, and Z is the z-score corresponding to the confidence level. Each method provides a different balance of complexity, accuracy, and assumptions, making them suitable for various risk assessment needs. Interpreting VAR. Interpreting value at risk. VAR is essential for risk management, but comes with limitations. Limitations, assumptions, and sensitivity. Different methods of VAR rely on assumptions, such as historical patterns, historical simulation, or a normal distribution of returns, variance covariance. These assumptions may fail under extreme conditions. Tail risk. VAR does not cover losses that exceed its threshold, leaving potential exposure to significant market shocks unaccounted. Stress testing and scenario analysis. Evaluating risk under different market conditions. Stress testing and scenario analysis are essential in risk management, examining how portfolios or financial institutions might fare during extreme market events. While VAR provides a snapshot of probable losses in stable conditions, stress tests simulate rare, severe occurrences, revealing vulnerabilities and guiding decision-making to bolster resilience in adverse scenarios. These techniques are vital for risk managers and financial engineers, offering insights that strengthen financial stability planning and enhance risk preparedness. Types of stress tests. Single-factor stress tests examines the impact of a single drastic change in a specific risk factor, like a large interest rate hike affecting bond portfolios or a significant drop in stock prices impacting equity investments. Multi-factor stress tests analyzes the combined effect of multiple risk factors, such as simultaneous fluctuations in interest rates and stock prices, assessing the cumulative impact on a diverse portfolio. Reverse stress testing starts with a severe outcome, identifying the conditions that would lead to a financial crisis or major loss, which helps in uncovering hidden vulnerabilities and planning for extreme scenarios. Implementation of stress tests. Defining stress scenarios. Scenarios are crafted based on historical crises, hypothetical situations, or regulatory requirements covering possible events like economic downturns, market shocks, or geopolitical crises. Modeling impact. Financial models simulate how defined stress scenarios would impact cash flows, portfolio values, and financial stability by applying changes in risk factors to evaluate performance under stress. Evaluating results. Results are analyzed to reveal potential weaknesses, guiding financial institutions in developing strategies for risk mitigation, enhancing capital reserves, and strengthening overall resilience. Scenario analysis overview. Scenario analysis is a technique used to assess the effects of different hypothetical scenarios on financial performance. Unlike stress testing, which primarily focuses on severe market conditions, it evaluates a wide range of potential outcomes, both positive and negative, to better understand a portfolio's or institution's resilience and potential for growth. Conducting scenario analysis. Scenario selection. Scenarios are chosen based on historical data, expert insights, and projections, ensuring a diverse mix of extreme and moderate conditions. Modeling and analysis. Models simulate how each scenario might affect key financial metrics like returns, asset values, and risk exposures, providing a detailed performance outlook under various circumstances. Risk metrics, Sharpe ratio, Sortino ratio, and other performance measures. Sharpe ratio. The Sharpe ratio, developed by William F. Sharpe, is one of the most widely used risk-adjusted performance measures. It quantifies the return earned per unit of risk, providing a standardized way to compare different investments or portfolios. Calculation. The Sharpe ratio is calculated as follows. Sharpe ratio equals where RP is the average return of the portfolio, RF is the risk-free rate, and SP is the standard deviation of the portfolio's returns. Sortino ratio. The Sortino ratio, an enhancement of the Sharpe ratio, focuses specifically on downside risk rather than overall volatility. It measures the return earned per unit of downside risk, addressing the limitation of the Sharpe ratio, which penalizes both upside and downside volatility equally. Calculation. The Sortino ratio is given by Sortino ratio equals where SD is the standard deviation of negative returns, downside deviation. Other performance measures. Traynor ratio. The Traynor ratio measures the return earned in excess of the risk-free rate per unit of systematic risk, as indicated by beta. It is calculated as follows. Traynor ratio equals where beta P is the portfolio's beta. The Traynor ratio is valuable for evaluating the performance of portfolios relative to market risk, emphasizing how well the portfolio compensates for exposure to systematic risk. Jensen's alpha. Jensen's alpha measures the excess return of a portfolio relative to its expected return based on the capital asset pricing model, CAPM. It is calculated as where RM is the market return. A positive alpha indicates that the portfolio has outperformed its expected return given its level of risk, while a negative alpha suggests underperformance. Information ratio. The information ratio assesses the return of a portfolio relative to its benchmark, adjusted for tracking error, the standard deviation of the portfolio's excess returns relative to the benchmark. It is calculated as information ratio equals where RB is the benchmark return and is the tracking error. A higher information ratio indicates that the portfolio has generated excess returns relative to its benchmark with lower tracking error.